On the Spot with Michelle Makori is brought to you by Prime XBT.
The U.S. banking system is sound and resilient. That is the word from Federal Reserve Chairman Jerome Powell. He made those comments as the Fed decided to raise interest rates again, and on the same week that saw the second biggest bank collapse in U.S. history. 3 of the 4 largest ever U.S. bank failures have occurred since March. Now, largely as expected, the Fed raised interest rates by 25 basis points to more than 5%. That is a 16-year high. And this was the 10th interest rate increase in just a little over a year. Now, there were hints of a pause in the FOMC statement, but in the Q&A section, Powell stressed that a decision on a pause has not yet been made. Well, here to help us analyze the latest from the Fed, what it means for the economy and what it means for your portfolio is Greg Foss, who says that owning Bitcoin does not increase portfolio risk, it reduces it. And that with all of the market uncertainty, the only thing that is certain is fiat debasing in a debt spiral. Greg is a Bitcoin strategist and executive director at Validus Power Corp, a company focused on sustainable energy. He has more than 3 decades of experience in high-yield credit trading as a portfolio manager and trader. Greg, welcome to Kitco. Good to have you with us.
It's a pleasure to be here. Thanks so much for having me.
All right, Greg, we have a lot of ground to cover. I want to get your thoughts on the latest from the Fed, your outlook for the economy, your outlook for the banking system, and of course, your outlook on Bitcoin, especially as a CDS or credit default swap against sovereign debt, which is how you see it. But before we start, I want to emphasize that you see both Bitcoin and gold as important assets to hold.
Yes, I do. I'm a 60-year-old. I've been working in what I call the fiat Ponzi world for over 30 years on both Wall Street and Bay Street. I'm a Canadian. Now, as far as hard assets go, I support hard assets. They can range from real estate to equities to gold and Bitcoin. I believe Bitcoin actually is the best hard asset of those. But I spent my career trading bonds, and I would term bonds a soft asset because bonds are basically nothing more than a fiat contract. And given that they are a fiat contract, they are programmed to debase just like fiat. So I support hard assets. I own gold. I own Bitcoin. I believe Bitcoin is the best of the hard assets, but you don't need to own all your hard assets in one silo.
Okay, we're going to get down to your Bitcoin thesis a little bit later on in the show. But let's start off with the latest from the Fed. As I mentioned, raising the key federal funds rate to more than 5% as it continues to fight against inflation. And in the Federal Reserve's post-meeting statement, people got excited because a key phrase was omitted, which was introduced in the last meeting. And that phrase was that some additional policy firming may be appropriate in order to bring down historically high inflation. Well, now, instead, the statement says that the Fed will be focusing on various economic and financial developments before determining the extent to which there would be additional rate increases. And we got a little bit more color on the position from the Fed chair when he spoke after releasing the statement. Let's take a listen.
Today, the FOMC raised its policy interest rate by 1/4 percentage point. Since early last year, we've raised interest rates by a total of 5 percentage points in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. We are also continuing to reduce our securities holdings. Looking ahead, we'll take a data-dependent approach in determining the extent to which additional policy firming may be appropriate. We always have to balance the risk of not doing enough and not getting inflation under control against the risk of maybe slowing down economic activity too much. And we thought that this rate hike, along with the meaningful change in our policy statement, was the right way to balance that. A particular focus for us going now over the past 6-7 weeks now and going forward is going to be what's happening with credit tightening. Are small and medium-sized banks tightening credit standards? and is that having an effect on loans, on lending? And so we can begin to assess how that fits in with monetary policy. That'll be an important thing.
All right, so that's an overview of what we heard from Fed Chair Powell. What was your takeaway?
Well, first of all, the removal of the last sentence, and he focused on that. You didn't show it in the clip here. Maybe you're going to show it. But I find it all quite funny that people dissect the word salad so appropriately, as if every word matters. I will say this. I think Jerome Powell is a horrible poker player. I think his body language reeks of desperation. He does say that the danger is that the Fed waits too long or in both directions. And in fact, that is always the danger, and the Fed always does. They tighten too much, but they waited too long to tighten at the outset as well. So this is a bit of a ping pong match that I've seen over my 30 years. Let's be very clear. You mentioned that he started by saying that the banking system is sound and resilient. I'm not sure if you've seen this after hours, Michelle, and this could be breaking news, but PacWest Bank is failing after hours. Okay, the bank stock is down 50% after hours. It's a very small bank, only 40 billion in assets, about 1/5 the size of First Republic, but nonetheless, it's on its way to the glue factory. Okay, so PacWest is done. It's over for them. There's probably another 20 banks that are in that position. So the banking system is not sound and resilient, Mr. Powell. You are not a good poker player. And the bigger news is not the Fed raising rates again to a range of 5 to 5.25%. It's the speed at which they raise the rates and the speed at which things are now breaking. So after hours, PacWest Bank stock, which was worth about $1 billion, which is still minuscule compared to its asset base, is now been carved in half as they announced that they are looking at strategic options. So I'm not sure if you saw this, but this today on Fed Day, the same day that Jerome Powell makes that statement, PacWest Bank is on its way to fail over the weekend, like all other banks do on a weekend, and it will be looking for buyers. My opinion only, but certainly that's the way the stock is trading after hours.
Right. And, we are then looking at the other regional banks, because when you hear something like this, all it does is create more fear, uncertainty, and doubt. And if you're a depositor in that bank, you're like, I don't want to stay in a regional bank. I'm going to pull my money out. So is there really any hope for these regional banks? I know that last time I checked, like the iShares ETF of regional banks was down about 35% year to date, probably worse now with this PacWest development. But can we see a banking sector with regional banks, if this continues to spread, if we have this uncertainty having a contagion effect?
Well, so I mentioned to you, I went to school in the USA. This was back in 1986. And when I started school in the US, there were 15,000 banks in the US, 15,000. And today there's less than 5,000. So in my 30-year career, over 10,000 US banks have been closed or merged. And that trend will continue, but there's still 5,000 of them. There's probably 25 meaningful regional banks that are going to fail, including the ones that have already happened, because First Republic Bank was a top 20 bank in the United States. When I say top 20, that's measured by the size of their balance sheet or the amount of loans they had outstanding. So PacWest is about 1/5 the size of First Republic. As I mentioned, it's $40 billion worth of loans. But this is a domino effect. There is contagion risks. This is like the S&L crisis back in the 90s, okay? Savings and loan crisis back in the 90s. One leads to another, leads to another, leads to a lack of confidence. There's two things that concern people, right? The first is that the banks are at risk of mismarking or not mismarking. The valuation of their treasury portfolio has been carved, and therefore the equity valuation of the bank has been vaporized. The other side is the deposit side. Yeah. How much is insured, but what can you do with those deposits? You can now take those deposits out of the bank and put them in treasury bills and earn 5% versus bank deposits that get paid less than that. So this is all part of this is a result of the Fed increasing rates to make alternative to deposits, so alternative investments to cash deposits like treasury bills, that much more attractive. Not only to mention, oh my goodness, if I'm worried about the bank failing, I'd rather have my deposits in treasury bills than I would in the deposits of a bank, right? So you can see how this is all circular. I'm going to quote Dallas Fed chairman, former Dallas Fed chairman Robert Kaplan, when he said we're only in the first innings of this banking crisis, regional banking crisis. And I'm also going to quote Charlie Munger, who I don't always see eye to eye on, but he said he believes there are another shoe to drop in the regional banking crisis as well. So just this afternoon is another example, and this isn't going to end. Despite what Jim Cramer says on TV, this is not going to end with First Republic, okay? That's not how banking works.
Well, you know, there's all the thing of the anti-Jim Cramer trade. If Jim Cramer says that you should probably go the other way. But look, you mentioned Charlie Munger. He did say that commercial real estate is going to be a big problem and probably going to be the next shoe to drop here. That sentiment echoed by Elon Musk, who said it's not a shoe, it's an anvil that's going to drop when these commercial real estate defaults start to hit, especially these regional banks. You say it's the first inning, quoting a former Fed person there, Kaplan, I believe. And yet we have Powell today saying that he thinks that we've drawn a line under the immediate crisis period. And I think it's important to play back his exact words, because as we're watching this, more and more faith in the Fed is being lost. So let's play back what Powell had to say about the banking sector, which he said was sound and resilient.
Let me comment briefly on recent developments in the banking sector. Conditions in that sector have broadly improved since early March, and the U.S. banking system is sound and resilient. We will continue to monitor conditions in the sector. There were three large banks, really, from the very beginning that were at the heart of the stress that we saw in early March, the severe period of stress. Those have now all been resolved, and all the depositors have been protected. I think that the resolution and sale of First Republic kind of draws a line under that period is an important step toward drawing a line under that period of severe stress.
Look, Greg, this is the same Fed chair that said inflation is transitory, and we know how that worked out. Now you have him saying the banking system is sound and resilient as another regional bank looks like it's on the brink of collapse. What does this mean for faith in the Fed if he makes these statements and then we see yet another bank collapse?
Well, yeah, your credibility is tarnished. I want to play poker against that guy, okay? He's not a good bluffer. You watch his hands, you see him touching his nose, not in this Fed meeting, but the last meeting when he tried to respond to a similar question, he touched his nose 3 times, which if anyone reads body language knows that means you're lying and you know it. Someone's obviously coached him to hold his hands on the podium, but he's still moving them around. Point is this, very simply, Michelle, banking is ubiquitous. Every single bank is levered 25 times to its risk-absorbing capital base, which is to say you only have $4 to $6 of equity capital for every $100 of loan you make. If that loan falls in value by more than $6, your equity is vaporized and you're chewing into depositors' money, because $6 is equity capital and $94 is depositors' money on every $100 of loans. I have lived through 5 banking crises, okay? I started my career during the Latin American debt crisis in 1988 and the Brady plan to solve the Latin American debt crisis. It doesn't change. It just gets dressed up in different colors and comes as a different calamity. And this one is coming based on interest rate risk, so mismanaging the interest rate risk in their portfolio by purchasing long-term treasury bonds and funding them with short-term deposits. because they were convinced Powell was right, that inflation was going to be transitory. Uh-oh, it wasn't. Now, here's the big problem. That's interest rate risk. Coming very quickly behind that is credit risk in the commercial loan real estate portfolio. 50% of commercial real estate loans are held by the regional banks.
Yeah.
And tell me they're not going to fall by more than 6% of their value? I don't think so. I think there's another shoe to fall, or as Elon says, yeah, it could be an anvil.
Okay, Greg, you correctly called Credit Suisse, a number of correct calls that you've made. If this commercial real estate starts to fall apart, defaults on those loans, a lot of bad loans in the banks, as Munger calls them, I mean, what does that mean? What does that mean for the banking sector? How many more failures and collapses can we see?
Oh, well, in theory, a lot more. My hope is that it does get contained. I'm not a doomsayer, but I also have spent my career in banking. I understand capital allocation and the BIS capital guidelines. And I will say that those guidelines are flimsy. Okay. Banking is a risky business, Michelle. Everybody assumes that banks are too big to fail. And largely the biggest banks are too big to fail, which means they will get bailed out. But it doesn't mean that shareholders get bailed out. And this is where a lot of money can be lost. Okay. There are probably, by my estimation, at least $10 trillion of bank equity globally. They can literally be wiped out if the system fails. It doesn't mean depositors don't get made whole. But in the case of Cyprus, they had bank bail-ins, right? This is another reason why you have to be very careful. A bank bail-in basically means depositors got a haircut as well. So this is the risky nature of banking. Just because you're JP Morgan doesn't mean you use a different formula for banking. The JP Morgan has capital ratios which are similar to these other banks. Perhaps JP Morgan managed their interest rate risk better and hedged it more properly. But look, you can look at the available for sale securities and the mark-to-market losses that are on Bank of America balance sheet, and you're blown away. You're like, oh my God, that would vaporize the lion's share of their equity as well if they had to sell or mark-to-market that portfolio. So at the end of the day, banking is banking. There will be more failures. Will they be cataclysmic failures? That's the difference. Contagion, where the system breaks down. Possibly. My hope is no. But I'm telling you, you saw Credit Suisse fail. Then you've seen, and Credit Suisse largely failed because of initial butterfly wings over in America. But listen, a few more failures in regional banks in America, and all of a sudden Deutsche Bank is on the ropes. And Deutsche Bank is way more levered than Credit Suisse was. Its derivatives book, which is off balance sheet, is way larger. And Deutsche Bank is a globally systemically important bank called a GSIB. And this will not be allowed to fail outright. It doesn't mean the shareholders won't get wiped out exactly the way Credit Suisse shareholders did. So these are the type of contagion events that slowly then suddenly the system breaks because of the leverage in the system.
And of course, then it comes to the governments to bail out those banks, which leads to fiat debasement, which is another one of your concerns and theories there linking back to Bitcoin. But before we get that, I'm sure most of our viewers want to know, you mentioned the situation with Cyprus. You discussed bail-ins on deposits, and we have had guests on the show explain that deposits could in fact be bailed in. Would you say that if you have deposits in some of the major banks, your deposits are safe at the $250,000 FDIC insured limit?
I can't say that with 100% certainty. So I've always managed risk on a probability basis. I'd say largely, if you ask me, yes, I'm greater than 60% certain, but I'm not 100% certain. And don't ask me to define it. All I will say is manage risk appropriately. A bank bail-in would cause the entire system to collapse, in my opinion, okay? You can do it in a small country like Cyprus, but try and do it in a G7 country. let alone the United States of America, the G1 country of the world, it would be cataclysmic. So I'll just tell you, I'm warning bank stock shareholders here as much as depositors, okay? Again, there's $10 trillion of bank stock market cap globally that literally could get vaporized. And that's the size of the gold market. And that's 20 times the size of the Bitcoin market cap that still lives in bank stocks that I think are mispriced relative to their risk. So, let's not go all the way down to the depositors. Let's focus on these equity guys.
Are there any bank stocks that you would consider if we see consolidation, we see the big players like JP Morgan benefiting from this, and JP Morgan at this point is way too big to fail?
Yeah.
Is there a bank stock that you would entertain at this point?
I'd rather not, only because contagion will bring them all down.
Okay.
Because here's the thing, again, JP Morgan is way too big to fail, but their bank stock can also go down an awful lot. And that's the key, right? Failure doesn't mean protecting the shareholder. Failure means they will protect the deposit holder or the lender, because when you give a deposit to a bank, you're effectively lending your money to the bank, but they will not protect the shareholder. You saw this in the case of Credit Suisse, where they had this bond called a COCO bond, a contingent convertible bond, or an AT1, alternative tier 1 bond. They got zeroed out, absolutely zero recovery on the bond, and they forced through some residual equity value. This is just rewriting the rules of finance in order to merge the banks under a very stressful scenario. So I'm not going to say, well, look, here's what I would say. Please don't own a bank stock because you think it's got a attractive dividend. That is not the way to look at a bank stock. The stock prices can go far lower, much like they did in the LDC debt crisis, and much like they did in the 2008-2009 great financial crisis, both of which I lived through. These are not times to be taking risk in levered financial institutions, in my opinion.
Okay. It seems a little trivial to even bring up this comment by Powell, considering what could be developing subsequently to his press conference. But he did say that a soft landing is still possible, or a mild recession. He said that the case of avoiding a recession, in my view, more likely than that of having a recession.
Yeah, okay. Horrible poker player. At the end of the day, however, I will tell you, this is the first time in my history that I've ever seen the Fed as a group predicting a recession, okay? This is it's unbelievable that they're actually predicting a recession as a group. And then Powell is on the outside saying, well, the group is predicting the recession, but I still think we can thread the needle and get this proverbial soft landing. Look, he said, I'm going to quote him, over time, you tell me, we're going to be lower for longer. What was he talking about? Oh, yeah, interest rates. Okay. We see inflation, but inflation is going to be transitory. Yeah. It wasn't. Now inflation is going to be higher for longer. He's 3 for 3 in being wrong. Okay. So I'm a betting man. I'm going to say he's going to be wrong 4 out of 4 times. I don't think he's going to be able to thread the needle on this soft landing. But maybe it doesn't matter, Michelle, because maybe the restriction in credit standards because of the failing banks and the financial conditions index forces a more destructive landing on the Fed. Because why? This is not monetary policy now. This is a question of leverage coming out of the system. So he's managing through the rearview mirror. I know Warren Buffett says he thinks that Powell is doing an amazing job. I'm going to take the absolute opposite side of the coin. I think he's a lawyer who's sitting in a risk chair, and he's very underqualified to manage the most important risk chair in the world. And I don't think he's doing a good job. Okay,
so given that, granted, it's a difficult job, and granted, many would agree with your position there, and that the Fed has been behind the curve here. But what is then your macroeconomic outlook? Do you see a hard recession?
No, I mean, here's what I watch. I watch credit. Credit is starting to raise the alarm bells. Okay. We had a very smart bond manager on CNBC this afternoon, Jeffrey Gundlach. I largely agree with his view. Yes, a recession. How severe will depend upon how long the Fed holds on to their failed policy of, lower for longer, now higher for longer. They always hold on too long. Here's the only thing I know for sure, Michelle. I don't make forecasts. What I do know for sure is I am 100% certain that fiat will debase in all scenarios. Okay? Fiat will debase. I'm 100% certain because that's only mathematics. We have a deficit in the United States. I say we has a deficit running. So the annual deficit is running at 7% of GDP. And the total accumulated debt is over 120% of GDP, which means next year it'll be 127% of GDP and then 134% of GDP. The only escape, the only way to solve that debt spiral is by printing more money. And when you print more money, fiat debases. And when fiat debases, soft assets lose their value, like bonds. Even if you get your money back, you lend the government $100 for 10 years, you get your $100 back in 10 years with a series of coupons. That $100 is worth $65 equivalent from time zero. This is not a sound investment. You need to be invested in smart, sound money assets, which include Bitcoin and include gold. And that's why I don't try and make forecasts. All I know when someone tells me or shows me something with 100% certainty, which is fiat debasement because of the debt spiral, I take measures into my own hands to protect myself and buy hard assets.
Right. The question, though, Greg, is the timeline of all of this. Before we get to the 100% debasement, in the very near term, do you see a rate cut? I get that in the grand scheme of things.
Yeah, I guess so. Because what do I see? I see the only way they're going to solve this is turn on the quantitative easing taps again, the QE infinity. So he's pretending he's doing quantitative tightening, but he's sucking and blowing, okay? He's doing quantitative tightening by allowing things to roll off the balance sheet. And then he announces the BTFP. I don't remember what it stands for. But I call it the backstop the fiat Ponzi, okay? The BTFP program. So it stands for something term funding program. That is effectively quantitative easing, but they're not admitting it that. You cannot lend at 100% of collateral value or par value on the bonds that are on a bank's portfolio. Even if they're worth 60% of par, you're giving them 100% collateral. I'll call that quantitative easing, Mr. Powell. Don't suck and blow. You are not doing quantitative tightening, okay? It's all a lark. And this is why they're gaslighting the public. It's really disgraceful. But that being said, that's what they have to do in order to keep this fiat Ponzi continuing.
And look, Greg, the issue of the debt ceiling came up for Powell to handle. Treasury Secretary Yellen has warned that the U.S. could run out of money to pay its bills by June 1st. If the debt ceiling isn't raised. Powell was like, this is not something that the Fed really handles, but it would not be good if that happens.
I agree.
When you combine that idea with everything else that's going on, including the broader de-dollarization trend, what do you expect regarding the debt ceiling?
Okay, they'll raise it. They'll get it through, and they'll get $1.5 trillion approved. And here's the funny thing: that will last for about 8 months before they have to come back and raise it again. Okay, just do your mathematics, people. Okay, $1.5 trillion raising the debt, the debt ceiling. They'll be back at the table in another 8 months. Because why? Again, I told you that the deficit is running at 7% of GDP. Just do the mathematics. It's grade 11 math. It's so simple to see how this is going to continue. The debt is going to go parabolic to the upside, and the Fed, including the Congressional Budget Office, are making predictions that 400% total debt to GDP in the USA is going to be funded. 400%, 4 times the size of the economy. As a credit guy my whole life, these are asinine numbers. And just to assume that this is going to continue, Jeffrey Gundlach mentioned today that he's very concerned with the credit status of the United States. I'm no Jeffrey Gundlach, but when the bond king of the United States calls out the credit worthiness of the United States, you better listen, okay? I spent my life in high yield credit, about 7 notches below this supposed gilt-edged credit rating of the United States. No, not going to work, people. You can only gaslight them for so long.
Yeah, and as you said, you believe that bonds are the dumbest investment that somebody could make, but that Bitcoin is probably the smartest way to ensure against a sovereign debt crisis and fiat debasement. You've said that Bitcoin can be seen really as a credit default swap, or CDS, against a sovereign debt crisis and debasement. So break that down for us.
Sure. So having been a credit CDS trader and a distressed debt trader my whole life, what is credit? What is a credit default swap? It's basically an insurance policy on the default of any counterparty. It started, and in my case, it was on distressed debt, not distressed debt, but junk debt or lower quality debt. But it goes all the way up the credit quality spectrum, all the way to sovereign debt, which is typically the highest rated credits within any country. So, the S&P and Moody's will have a cap on the ability of a company to be rated higher than the sovereigns. Then one day there was a time when the drug companies in the US were rated higher than the credit quality of the USA. But at the end of the day, understand what happens. You have various tranches of credit risk as measured by the credit rating agencies, subjective credit rating agencies. Here's the truth. If the USA could not print money to solve their debt burden, they'd be the equivalent of a CCC rated corporation, because the USA does not even cover its interest expense 1 turn from its EBITDA, if you will, or free cash flow. Why? Because the USA has entitlement spending and it has military spending, and the residual is not enough to pay for the interest expense. So the USA is a zombie borrower, but it can print money. So there is a credit default swap market that prices the probability of default of the USA. It's not zero because of things like potentially a failing country, but it still is very minute compared to the risk of corporate credits in the CCC realm, the zombie company realm. Nonetheless, you can look at Bitcoin as being insurance on the failure of a basket of fiat currencies, a basket of sovereign debt. And in that calculation, you can take the open market CDS spreads and multiply those CDS spreads by the outstanding debt of a nation. And let's do it really quickly for the USA. All right. 5-year CDS to make the math easy on the USA. 5-year CDS on the USA, we're going to use a number of 40 basis points. That's low, but that's an open market credit default swap rate on 5-year CDS, which means it's got an 8 basis point per year tenor. Okay, you take 5 years, you divide it by the 40 basis point cost of the credit default swap. What does 40 basis points mean? It means it costs you $40,000 a year to insure $10 million of US debt against default. Seems like a fairly minute amount of insurance to protect, or premium, an insurance premium, to protect $10 million of US debt, but it's not zero, which is to say there's a default risk according to the market. So if 5 years is 40, what would a 20-year CDS equivalent? They don't trade at 20 years, but let's put out a 20-year number. 20 times 8 per year gives you 160 basis points. Now, the total funded and unfunded liabilities of the United States of America is approaching 200 trillion US dollars. 30 trillion or 32 trillion of funded debt, though that's debt that's existing in the system, and another 170 trillion of unfunded liabilities, which include future Medicare and Medicaid obligations and Social Security to the public. So $200 trillion is the liability just of the United States, Michelle. You take 160 times 200 trillion, and you get, I'm doing it in my head, $3.2 trillion would be the implied insurance value on the United States. $3.2 trillion just on the United States. What is Bitcoin trading for? Well, about $500 billion. Oh my God. If people embrace the thesis that Bitcoin could be viewed as credit default swap insurance on USA and all other countries, well, it's trading about 1/7 of its value just for the USA. And here's the really cool thing. There's no counterparty risk. Bitcoin is not an insurance company. When you hold it in self-custody, you don't have to worry about buying this insurance from an insurance company like Bear Stearns. See, when I was trading credit default swaps, I had an exposure to Bear Stearns that meant I thought I was going to have insurance from Bear Stearns. And guess what? When Bear Stearns looked like it was going to fail, I had to run out and buy insurance on my insurance company. You see how this whole circular thing works? Bitcoin is so beautiful because there's no counterparty. So there's a way to value it, and there's a way to appreciate that it has no counterparty risk. And then you could say to me, well, Greg, isn't the same thing said about gold? And I'd go, yes and no, because gold has no fixed supply. It's not transferable or portable like Bitcoin is. And most importantly, it's not auditable. There is no blockchain to audit it. And I still like gold, don't get me wrong. But at the end of the day, Bitcoin is so superior as not only a technology, but also as an auditable asset. That is why I love Bitcoin, as effectively, in my view, from a credit trader's perspective, my whole life, it is the most beautiful insurance policy on the failure of fiats globally. The USA will be the last one to fail, Michelle. The USA will be the last fiat to fail, but there's 150 other fiats that will fail before the USA, and that's why it's valuable to places like Argentina.
Okay, wow, Greg, a lot to unpack there. Firstly, you've said that fiats are worthless, that they have subjective value. Okay, you've written that in your reports, and that's linked to what you're saying now, that fiat is programmed to debase, agreed there, have subjective value, fiat, Latin, by decree, because I said so, agree there. But, and I understand that you have a formula to calculate the value or price of Bitcoin depending on the chances.
Which I just tried to show how it works for every country, yep.
But that sort of hinges on the fact that people see Bitcoin as the insurance here. I get that that is a way to determine the value or price of Bitcoin, but doesn't Bitcoin also have subjective value, like the fiat currencies do? Fiat currencies do.
Yes and no too. I was flattered when Michael Novogratz. Now I can't say that Novo got the idea that Bitcoin is credit default swap insurance on sovereign debt, but he tweeted that out the other day, and a lot of people came up back to him and said, "Hey, haven't you seen that this kid in Canada, Foss? Even though I got all my training in the United States, Foss has been saying the same thing." No response. It doesn't matter. If the thesis is leaking out, it will, be spread by bigger money risk managers who tend to look at it from a credit lens. And I will tell you, another guy that I have enormous respect for at Golden Tree, Tannenbaum, Steve Tannenbaum, he loves Bitcoin for a similar reason. And all I'll tell you is it resonates with the credit guys more quickly than it resonates with, firstly, equity guys who, in my view, are not always the sharpest tools in the shed. And then the run-of-the-mill, mom and pop. It takes a long time to permeate the entire spectrum, Michelle. So yes, everything has subjective value, but I'll just tell you, for guys that have spent their life in credit, man, it's like the penny drops right away. They're like, oh my God, this is exactly the hedge I've been looking for my whole life.
Right. Again, though, just to play devil's advocate
I love
here,
you.
Greg.
Go ahead. Go ahead.
It hinges on broad consensus that Bitcoin is that insurance.
No, sir. No, ma'am. No, ma'am. Because everybody can use different ways of valuing it. Other people can value it based on a technology. Other people can value it based on an information transfer protocol. So technology stock guys who I know have bought Bitcoin in Canada, they think of it as a technology, not as an insurance product. And then credit guys think of it as an insurance product. And you may think of it as totally something else. Store of value, store of wealth. All of this is what determines an open market price on Bitcoin. And that's the beauty of unmanipulated market, okay? Bitcoin is unmanipulated. The fiat Ponzi is manipulated by guys like Jerome Powell, who gets up there and tries to manipulate your cost of funds using antiquated technology and rear view mirror driving, okay? This is the problem with capitalism today. Bitcoin is a free and open market. It's a thing of beauty, and it means different things to different people, and it can get valued in a whole lot of different ways. Ultimately, it settles on a market price that is not manipulated. It's beautiful.
And what you've described is what you call the fulcrum index.
That's
which
correct.
Is
yeah.
what you've devised.
Let's not go too far, but just imagine the idea that I laid out with the USA. Take that for the USA, add in all the G7
G20.
Nations, yeah, go all the way down to the G20. You'll come up with a number that's over $700,000 US per Bitcoin using credit default swaps. Hey, it's trading under 30,000. It's trading at let's do the math. It's trading at 1/27th of its intrinsic value, according to, I say the word intrinsic, you don't agree with me, I don't care. It's still 1/30th or 1/27th of the value that you could put on top of Bitcoin as a valuation metric. I don't sweat it. It's so stupid cheap. Don't overthink things. I could even give you a higher target price based on a share of total addressable market. I don't want to go there. I'm just going to say, if you own 0 Bitcoin, you're a fool. It is the best asymmetric investment opportunity I've ever seen in 35 years of managing risk. And we're listening to guys like Taleb and Charlie Munger, who are conflicted fiat Ponzi fools who are trying to say it has 0 intrinsic value. I'll take the other side. Thank you, sir. Because I think it could go many times higher. Thank you.
Look, I hear that, Greg, and I'm not saying I necessarily disagree with you,
by
the way. Not at all. Just pushing back here again on this idea of intrinsic value.
Sure.
Because, that does mean different things to different people. Typically means a tangible use for a product. I mean, if you look at the intrinsic value of a stock, for example, there are various ways to calculate 100%. That. You've got discounted cash flow analysis. You've got asset-based valuation.
Mine is one model. There's many models to do it, Michelle. And here's what I would just like to say. You will not tell me or convince me that I'm wrong, because I've spent my entire life in that ring, okay? The credit ring. And I believe credit runs the world. Not only believe, I am certain of it. Why? Because there's $400 trillion of global debt. And there's only $100 trillion of global equity. Okay, so it's 4 times the size of the global equity market. It runs the market. If you don't know what's happening in credit, you're flying blind. And most equity guys are blind to what's going on in the credit markets. I've seen it every single crisis in my career. No disrespect, I guess a little disrespect, because credit has a prior claim in the capital structure. And if you don't know what's going on in the prior claim in the capital structure, you shouldn't be investing money. However, too many people don't know what's going on in the prior claim of the capital structure.
All right. Well, Greg, you have said, though, that you think it could be a matter of time before Bitcoin is actually the unit that energy is priced in, especially when we take into account the whole idea of de-dollarization, a trend that is accelerating with more and more countries choosing to trade in countries other than the dollar, with the petrodollar looking somewhat shaky, with Saudi Arabia accepting other currencies for the dollar, and again with the BRICS currencies coming together and looking at a global reserve asset to challenge the dollar, potentially backed by commodities. So how do you see oil being priced in Bitcoin? Play that scenario out for me. Does it hinge on Russia accepting Bitcoin for oil?
Well, okay, let's start with first principles. I'm an engineer. I believe in the law of conservation of energy. It's drilled into your head as an engineer. And I look at Bitcoin as digital energy. Okay, so I think very simply in a closed system, if you're going to sell your valuable natural resource energy, oil and natural gas, for fiat dollars that can be debased, you're not, there's an alternative to sell it for digital energy. So you're selling natural resource energy in trade for digital energy that should maintain its value and increase in value over time because of its fixed supply. I'm like, man, that's a better way to price my valuable natural resource energy. Is it going to happen overnight? No. Should Canada do it? I would love Canada to do it, but we're not smart enough. But you know who is smart enough? Vlad Putin. And I'm not supporting the man, but he didn't just fall off the turnip truck, okay? He knows that selling his valuable natural resource energy for debasing US dollars is a loser's game. And he's moving away from that. And I believe there will be time within my lifetime that oil and natural gas are priced in Bitcoin, because I'm an engineer and I believe it's the most logical pricing mechanism. Does it mean that the US loses US reserve currency status? I hope not. If the USA is smart enough to embrace Bitcoin, it could also maintain US reserve currency status. What will get debased is US reserve asset status, which is US Treasuries. Bitcoin will replace US Treasury bonds as the global reserve asset. All of these are part and parcel of a progression. When will it happen? Look, I can give a target, but not a time. I'd be a fool to do both. But think about the law of conservation of energy. Energy can neither be created nor destroyed. Understand that this is why Bitcoin is the solution for so many different things in this world. A beautiful technology and a beautiful store of value. No disrespect to gold. Don't sell gold to buy Bitcoin. Sell part of your bond portfolio to buy Bitcoin. Because if you own 0% Bitcoin, you are actually taking more risk than if you had an appropriate portfolio allocation to Bitcoin. I can prove it. We don't have time. I have a hard stop in a couple of minutes here, Michelle. But I want to tell you this. Again, don't overthink things. If I succeed in getting you to get 5% of your portfolio in Bitcoin, worry about the other 95% of your portfolio that's not in Bitcoin, please. And I'll talk to you in 20 years. Hopefully I'm alive, God willing. I'll talk to you in 20 years. That's the way to look at Bitcoin.
I know we're running out of time, and I know you don't like to give targets per se, but given these calculations and such, what would you say is your outlook for Bitcoin, say price-wise, with your valuations?
I'll ask it in a rhetorical question. How quickly does the fiat banking system collapse? Does the US actually default on some debt? And the answer is, I don't care, because the price is going higher and it's such a rounding error. It's going up forever, Laura. I'm not sure if you know what that means, but that's the famous Michael Saylor talking to Laura Shin. Okay. It's going higher because it is the best store of value and hard asset in a world where fiat currency is debasing. I'm really sorry I have to leave. You've been so pleasant to talk, and understand this.
Can you tell me how you're structuring your portfolio as a final question then? Given you say people should have some Bitcoin exposure.
I own about 25% Bitcoin in my portfolio, but it didn't start at 25%, okay? I was lucky enough to get into Bitcoin over 7 years ago. I've continued to research it my entire career, and I've also seen the thesis of why I own it come more to fruition. Because the response to the COVID crisis ensures that the debt spiral globally, we can never escape it. In fact, it's accelerating. It's only grade 11 math. So when you see that happen and the information changes, meaning you have even more conviction, own more Bitcoin. But to the people out there that own 0, do me a favor and at least get 1 to 5% of your portfolio in Bitcoin, and then worry about the other 95% of your portfolio, please. That's the way to manage risk.
All right. Well, Greg, I know we're out of time. Appreciate your analysis, and we'll have to have you back on very soon because a lot more questions to break down with you. But we're out of time for now. Greg Foss, really appreciate it. Thank you.
Thank you so much. It's been a pleasure. Thanks for having me, everyone.
Thank you. And once again, thanks to our sponsors, Prime XBT. I'm Michelle Makori. If you're watching this on YouTube, make sure to subscribe. We'll see you soon.
On the Spot with Michelle Makori is brought to you by Prime XBT, the leading cryptocurrency trading platform.